want you to imagine something for a moment. It's the year 2036. A full decade has gone by since you bought your dream home. You actually did it. Against all odds, in the absolutely brutal housing market of 2026, you found a way. You snagged a mortgage with a payment that didn't just feel affordable. It felt like a total steal. You've been paying it down diligently, month after month, for 10 straight years. You've poured over $100,000 into this house. It's your home. Then life happens. You get a fantastic job offer in a new city. You need to upsize for a growing family, or maybe you just want a change of scenery. You decide it's time to sell. You call your lender to get the payoff amount, and the number they give you makes your blood run cold. You still owe pretty much the full price of the house. After 10 years and 6 figures in payments, you've barely made a dent in what you actually owe. In fact, after you factor in closing costs, the person on the other end of the phone calmly informs you that to sell your own home, you will need to bring a check for $41,000 to the closing table. This isn't a nightmare, and it's not a scare tactic. This is the hidden mathematical reality of a new financial product being dangled in front of desperate homebuyers right now. The 50-year mortgage. It's being sold as a golden ticket, the one weird trick to finally make homeownership affordable in a market that has locked so many people out. But it's a trap. It's a sweet-sounding song luring you straight onto the rocks of financial ruin. This loan pretends to be about affordability, but it's really designed to secretly drain your bank account for your entire life. Today, we're going to expose exactly how this loan can double your interest costs, trap you in debt for the rest of your natural life, and what you absolutely must do to protect yourself and your family from making what could be the single worst financial mistake of your life. And hey, if you appreciate this kind of in-depth, no-nonsense financial analysis, do me a favor and hit that subscribe button. It tells YouTube you want more content that respects both your intelligence and your wallet. Now, let's get into it. So, to understand why a 50-year mortgage sounds so tempting, we have to understand the pain that so many aspiring homeowners are feeling right now in 2026. The American housing market is in a state of crisis. There's really no other way to put it. We've been through a whole mess of economic problems all hitting at once. First, the pandemic era saw interest rates crater to historic lows, way below 3%. That, combined with a sudden shift to remote work, lit a fire under the home buying market. Prices went through the roof. Then, to fight runaway inflation, the Federal Reserve started aggressively hiking rates. Mortgage rates, which are tied to the Fed's policies, shot up, peaking around a staggering 7.8% in late 2023. This created a brutal lock-in effect. Homeowners who had bought or refinanced at 3% weren't going anywhere. Why would they? Selling meant giving up a once-in-a-generation mortgage rate, only to buy a new home at a much higher price and a much, much higher rate. So, housing inventory just evaporated. For anyone who didn't already own a home, the situation got pretty dire. By early 2026, we've seen a little relief. The average 30-year fixed rates have finally dipped below 6% for the first time in years, hovering around 5.98% to 6.18%. But home prices are still stubbornly high. The median home price is still sitting near $400,000, a massive jump from just a few years ago. The typical homeowner is now spending close to 40% of their income on housing, way over the 30% benchmark that experts recommend. This is the kind of desperation that gives birth to dangerous ideas, and the 50-year mortgage is maybe the most dangerous of them all. It's been floated as a game changer for affordability. The logic seems simple enough. If you can't afford the payment on a 30-year loan, just stretch it out. Spread the same debt over 50 years. That's 600 monthly payments instead of the standard 360. And presto, the monthly payment goes down. And it does. On a hypothetical $400,000 loan, stretching the term from 30 to 50 years might lower your monthly principal and interest payment by anywhere from $165 to maybe $340 a month. To someone stretching every dollar, to someone who keeps losing bidding wars, that $200 a month feels like a lifeline. It could mean qualifying for a slightly nicer house, freeing up cash for groceries, or just finally escaping the cycle of rent hikes. This is the sales pitch. This is the cheese in the mousetrap. It preys on your short-term pain to distract you from the catastrophic long-term consequences. And that's what we're here to expose. Let's break down the 3 devastating traps of the 50-year mortgage. Okay, this is the part where you need to pay close attention. This is the central, unshakable fact that makes the 50-year mortgage a financial disaster. While you save a couple of $100 a month, you end up paying an astronomical, life-altering amount of extra interest. Let's do the math. It's not complicated, but it is shocking. We'll use a conservative and realistic example for the 2026 market. Let's say you take out a loan for $400,000. First, let's look at a standard 30-year fixed-rate mortgage. Rate forecasts for 2026 put the average between 5.9% and 6.4%. So let's be generous and say you get a rate of 6.25%. Your monthly principal and interest payment would be about $2,462. Over 30 years, you'll pay a total of $886,320. Subtract the $400,000 you borrowed, and your total interest cost is $486,320. Now, that's already a sobering number. You're paying more in interest than the loan itself. That's just the nature of long-term debt. But watch what happens next. Lenders see longer loans as riskier, so they almost always charge a higher interest rate. A conservative estimate is a rate premium of about 0.5%. So for our 50-year mortgage on that same $400,000 loan, let's assume an interest rate of 6.75%. Your monthly principal and interest payment would be about $2,246. This is a monthly savings of $216. This is the bait. This is that seductive whisper telling you this is a good idea. But what's the real cost? Over 50 years, that's 600 payments, you will pay a total of $1,347,600. Subtract the $400,000 you borrowed and your total interest cost is a jaw-dropping $947,600. Let's put those numbers side by side. Total interest on 30-year loan, $486,320. Total interest on 50-year loan, $947,600. You're paying an extra $461,280 in interest. Let me say that again. For the privilege of saving $216 a month, you are handing the bank nearly $500,000 extra dollars. You're not just buying your house anymore. You've paid for your house, and then you've paid for another house for the bank. In many cases, the total interest paid on a 50-year loan can be more than double what you'd pay on a 30-year. You are essentially paying for your home 3 times over, once for the principal and twice in interest. Think about what that extra $461,000 could do for your life. That's retirement. That's your kids' education. That's starting a business. That's financial freedom. With a 50-year mortgage, you are basically lighting that money on fire and handing the ashes to your lender. The average age of a first-time homebuyer in the United States is now around 40 years old. If you take out a 50-year mortgage at age 40, you will be making your final house payment at age 90. Do you really want to be sending a mortgage check to the bank when you're 85, knowing that for the last half-century, most of that money was pure profit for them? This isn't just a loan, it's a commitment to a lifetime of debt. It changes homeownership from a tool to build assets into a rental-like deal where the bank is your permanent landlord. If the interest volcano wasn't enough to scare you off, this next trap should. It's more subtle than the raw interest math, but in many ways, it's even more sinister. It's the trap of equity, or more specifically, the complete and utter lack of it. Equity is the part of your home you actually own. It's the difference between what your house is worth and what you still owe on the mortgage. Building equity is the main way home ownership creates wealth. It's your forced savings account. It's what lets you sell your home and walk away with cash in your pocket. Equity is freedom. A 50-year mortgage is the enemy of equity. To see why, you need to understand something called amortization. An amortization schedule is just the breakdown of how each monthly payment is split between interest and principal. In the early years of any long-term loan, the vast majority of your payment goes to interest. As the loan gets older, that balance shifts and more of your payment starts paying down the actual loan. With a 30-year loan, this is already a slow process. With a 50-year loan, it moves at a glacial, soul-crushing pace. Let's go back to our $400,000 loan example. On the 30-year loan at 6.25%, after 10 years of making payments, totaling nearly $300,000, you would have paid down about $79,000 of your principal. Your loan balance would be roughly $321,000. You've built a real stake in your home. Now look at the 50-year loan at 6.75%. After 10 years of payments totaling over $269,000, how much principal do you think you've paid off? The number is so pathetic, it's insulting. You would have paid down just $20,000. Some analyses show you'd have only paid off as little as 4% of the principal in the first decade. Your loan balance is still a staggering $380,000. After 10 years and over $250,000 in payments, you own a measly 5% of your home beyond your down payment. Let's look even further out. After 20 years, the 30-year borrower has paid off 46% of their loan. They have serious equity. The 50-year borrower has paid off only 11%. And after 30 years, the person with the 30-year mortgage is celebrating. They've made their last payment. They own their home free and clear. It's a massive wealth-generating asset. And the 50-year borrower, after 30 years, they still owe an unbelievable $327,000 on their original $400,000 loan. They've paid the bank over $800,000, and they're still almost as in debt as the day they started. This isn't just a number on a spreadsheet. This has terrifying real-world consequences. This lack of equity is quicksand. The moment you step into it, you start to sink. What happens if home prices dip, even a little? If you have no equity, you can instantly find yourself underwater, owing more on your mortgage than your home is worth. If you're underwater, you can't sell your home unless you're willing to bring a massive check to closing just to cover the difference. You are trapped. And that brings us to the third trap. When you combine the insane interest cost with the pitiful equity growth, you get the third and final trap, the golden handcuffs. You have a house, but you have zero financial flexibility. Your biggest asset becomes a liability that dictates the terms of your life. Home equity isn't just for building wealth on paper. It's a vital financial tool. It's the reservoir you tap when life happens. Need to pay for a sudden medical emergency? You can use a home equity line of credit, HELOC. Want to start a business or pay for your kids' college? A home equity loan can give you the capital. Get a dream job offer in another state? You sell your house, use the equity for a down payment on a new one, and you move. With a 50-year mortgage, you can do none of these things. For the first 15 to 20 years, you have almost no equity to borrow against. You are handcuffed to your property. Think back to our story at the beginning. That scenario where you need to sell after 10 years and find out you have to pay the bank to let you leave? That wasn't an exaggeration. It's the direct result of this equity trap. If you've only paid off $20,000 of your principal, but you need to pay a 6% real estate agent commission to sell the home, which on a $400,000 house is $24,000, you are already in the red before you even think about other closing costs. You are literally trapped. This trap also wrecks one of the most powerful financial strategies, refinancing. You hear the mantra, marry the house, date the rate, which means you can buy now and just refinance when rates drop. But refinancing isn't magic. Lenders typically require you to have at least 20% equity in your home to approve a refi. With a 50-year loan, it could take you decades to reach that 20% equity mark through payments alone. You'll be stuck with your original, higher interest loan while your neighbors with 30-year mortgages are refinancing and saving thousands. You are locked out. This lack of mobility is a prison. What if your neighborhood changes for the worse? What if you need to move to care for an aging parent? What if your family outgrows the space? With a traditional mortgage, these are manageable life events. With a 50-year mortgage, they become financial crises. You can't afford to stay, and you can't afford to leave. On top of all that, it devastates your ability to create generational wealth. A home is often the largest asset people leave to their children. But if you pass away 25 years into a 50-year mortgage, you're not leaving your kids a valuable asset. You're leaving them a massive debt. They inherit a home with a huge mortgage balance still attached, forcing them to either sell it, possibly at a loss, or take on the burden of the payments themselves. The dream of giving your kids a head start becomes a nightmare that chains them to your mistake. Okay, this is all pretty bleak, I know, but my goal here isn't to scare you, it's to arm you with the truth. These financial products are designed to look great on the surface, but they are built on a foundation of financial quicksand. Navigating this crazy market requires a clear strategy. That's why we've put together a free downloadable guide called the Homebuyer's Sanity Check. It's a simple one-page checklist of the critical questions you need to ask yourself and your lender before you ever sign on the dotted line. The link is in the description below. It's totally free, and it could save you from half a century of regret. Now, a defender of the 50-year mortgage might raise a few points. It's only fair that we tackle them head-on. Argument 1. But it's still better than renting. On the surface, this feels right. When you rent, your money vanishes every month and you build zero equity. At least with a mortgage, some of your payment is going towards ownership. but this is a dangerously simple way to look at it. While renting builds no equity, it provides something incredibly valuable: flexibility. If your rent gets too high or a better job pops up somewhere else, you can move at the end of your lease, usually within a year. A 50-year mortgage, as we've established, can trap you in a property for a decade or more, making it less flexible than renting. Plus, as a renter, you aren't on the hook for maintenance, repairs, or property taxes. When you own a home with a 50-year loan, you carry all of those costs while building almost no equity for years. It's like having all the responsibilities of ownership with none of the financial perks. Argument 2. It gets your foot in the door of home ownership. This is the most common argument, that it's a tool for access. But what kind of access is it, really? It's like being invited to a feast, but being told you can only eat the crumbs that fall on the floor for the first 20 years. It gives you the title of homeowner without the actual financial substance that comes with it. Worse, if 50-year mortgages became common, they could actually make the housing crisis worse. By artificially increasing the number of people who can afford to buy, it pumps more demand into an already supply-starved market. This just leads to more bidding wars and drives prices even higher, canceling out the so-called affordability benefit and making homes more expensive for everyone. It just pours fuel on the fire. Argument 3. I'll just make extra payments to pay it off faster. This is a noble thought, but it's often unrealistic. The very people drawn to a 50-year mortgage are the ones who are financially stretched thin to begin with. The extra $200 to $300 a month they save is often immediately eaten up by other rising costs, like insurance, utilities, and groceries. While making extra payments is always a smart move, betting your entire financial future on having extra cash lying around is a risky bet. Life is unpredictable. If you can afford to make big extra payments, you should have been in a more aggressive, shorter-term loan from the start. The 50-year mortgage is a solution in search of a problem that it actually makes worse. It doesn't solve the affordability crisis, it just papers over it with a lifetime of debt. So, if the 50-year mortgage is a trap, what are you supposed to do? Is homeownership impossible? No. It's tough, but it's not impossible. You just have to play the game smarter, focusing on what actually works, not on dangerous gimmicks. Here are 3 real, actionable strategies. Strategy 1. Adopt the 15-year mindset, even on a 30-year loan. Instead of stretching your loan term out, think about shortening it. A 15-year mortgage has a higher monthly payment, sure, but the interest savings are incredible, and you build equity at lightning speed. If a 15-year loan is out of reach, get the best 30-year fixed-rate mortgage you can, and then commit to paying it like it's a shorter-term loan. Use a mortgage calculator and play with the extra payment field. You will be stunned to see that adding just $200 or $300 extra to your principal each month can shave 7 to 10 years off your loan and save you over $100,000 in interest. This gives you the safety of the lower required payment of a 30-year loan, but the power to build wealth on an accelerated schedule. It takes discipline, but it puts you in control, not the bank. Strategy 2. Go on the offensive with your down payment. In the race for a lower monthly payment, people often forget the most powerful weapon they have: the down payment. A larger down payment shrinks the total amount you have to borrow, which lowers your monthly payment, slashes your total interest cost, and helps you avoid expensive private mortgage insurance, PMI. Instead of rushing to buy with the bare minimum, think about waiting another year or two and saving aggressively. Get ruthless with your budget, cut out the fluff, and look for ways to boost your income. Also, look into down payment assistance programs. There are tons of federal, state, and local programs that offer grants and low-interest loans to help first-time homebuyers. A larger down payment is the single best way to make your mortgage truly affordable for the long haul. Strategy 3. Get creative with your housing strategy. The classic single-family home isn't the only way to go. Consider house hacking. This is where you buy a multi-unit property, a duplex, triplex, or even a fourplex, live in one unit, and rent out the others. That rental income can offset or even completely cover your mortgage payment. Government-backed loans like FHA loans are perfect for this, since they let you buy multi-unit properties with a very low down payment. Also, look into other government loan programs. USDA loans offer 100% financing for homes in eligible rural and suburban areas, meaning zero down payment required. VA loans offer a similar amazing benefit for veterans. These programs are designed to make homeownership accessible without forcing you into predatory loans. These strategies take more effort than just signing up for a 50-year loan, but the payoff is real, sustainable homeownership, not a life sentence of debt. The dream of owning a home is a powerful one. It represents stability, security, and a piece of the American dream. In a market like the one we face in 2026, it's totally understandable why a product promising a shortcut to that dream would be so tempting. But some shortcuts lead directly off a cliff. The 50-year mortgage is not a tool for affordability. It is a tool for indebtedness. It is a financial instrument mathematically engineered to transfer the maximum possible amount of your wealth into the lender's pockets. It asks you to trade a tiny bit of monthly relief for a lifetime of financial servitude. It traps you with an interest volcano that can double the cost of your home. It traps you in equity quicksand, making sure you own almost none of your home for decades. And it traps you with golden handcuffs, stripping you of the financial flexibility that is supposed to be one of the greatest perks of owning a home. True financial freedom isn't about having the lowest possible payment today. It's about making choices that build your wealth and expand your options for tomorrow. Don't sacrifice your future for a few bucks of savings in the present. Run the numbers, understand the trap, and choose a path that leads to actual ownership, not a 50-year lease from the bank. Your future self, and maybe even your kids, will thank you for it. Thanks for watching. If you found this video valuable, please give it a like and share it with someone you know who's thinking about buying a home. And don't forget to subscribe for more honest financial advice. We'll see you in the next one.